Yo, what's up, dude? I'm just gonna make these videos because I meant to ask you before you left for work how you wanted me to send you this information. But I figured I'll just make you a video and I'll explain what I'm trying to have visualized, just for learning purposes for the Forex market. So I guess I'll just get started. The foreign exchange market. I trade what is the Forex market, which is the foreign exchange market, dealing with currency pairs, such as Euro USD, which would be the euro, and our US dollar that we use. You can trade the Japanese yen to the US dollar. You can trade the Great British Pound to the US dollar. There's a bunch of currency pairs that you can trade. Um, the Forex market is over $5 trillion a day industry. So you have literally $5 trillion just flowing around. A lot of it's big banks and just other big entities that have the millions of dollars to throw around, if not billions of dollars, probably billions of dollars. But they're able to throw it around. I'm just like a regular consumer trader. I don't know if there's a technical word for us regular traders, but technically we're nobodies, and nobody gives a shit about who we are and what we do within the market because most people are just dumb. And I've been dumb for like 4 years trading. People just don't know what they're doing. And even if you do know what you're doing, you can still jack up a whole bunch. But I'm going to get into that later. For now, I'm just going to explain the Forex market in a different light and in a way to get people to maybe understand it better, because this is something that I just recently kind of realized, or at least it's a frame of mind of that I just recently thought of, and it makes a whole bunch more sense on how to understand the market and how it moves. There's obviously no proof, because if there was proof on how the market moved, then everybody would make a shit ton of money. But based on analysis and what I have been doing and what I know, it all makes sense, and that's why it works, and I know it does. But anyways, when you think of the word exchange, I would have to ask you, what do you think of? And for me, I think of an exchange as two people having a business. It's almost like a business contract. It's just an exchange. And so you have two parties that are working together. I would consider an exchange. Two people are working together, and they have some say so. They both have say so in what goes on in the matter. And so knowing that, that's my definition of an exchange, is two people willingly working together to exchange something for another. So when I think of the foreign exchange market, I think of, well, obviously we deal with currency pairs in the foreign exchange market, but when dealing with these currency pairs, you actually have pairs. And so, as I said earlier, you have the Japanese yen to the US dollar. The price fluctuates between the Japanese yen to the US dollar. I think right now it's floating around 109.862. And so, having lived in Japan for 4 years, for every $1 that you have, it would be 109 yen. And now, granted, a soda pop or would cost you, or Coca-Cola, it would cost you about 109 yen, whereas a Coke here would cost you $1. So the price is pretty similar. I mean, it fluctuated a lot in the 4 years that I was there, ranging from, I think it went down to like 98. So $1 was 98 yen, all the way up to $1 was 125 yen. And those were good times. But anyways, you're talking about price fluctuating in 4 years, maybe 30 cents. So when you talk on the consumer level of the foreign exchange market and the fluctuation of these currency pairs, the price moves 24 hours a day, 5 days a week. And so you're in the foreign exchange market, we make contracts on trades, and based on your technical analysis, you'll determine whether the price will go up or the price will go down. And even within a 24-hour period, such as like the Japanese yen to the US dollar, that would still stay on the consumer price at 109. But during the day, you're talking 109.862. It could go from 109.869 to 109, or it would go down to 109.800. And I mean, you're talking that would be like a 60 pip movement. Um, that would technically be a slow day in the Forex market, but it's still possible. The Forex market would move literally every second of every hour for 24 hours, one full day. It would move all day, and it wouldn't affect the consumer whatsoever, not at all. But your traders, they're the ones that make money off the movement of that price. So even though it doesn't mess with the consumer, it messes up the investors, or it messes with, if you don't know what you're doing, it messes you up. But that's the difference, or more or less, like everybody's trading this. Like consumers, your regular people, it doesn't matter. And that's why I think most people don't really get into it. But back to the exchange part, is it's two people, they're dealing with a currency pair. So if I'm an American and I'm over in Japan and I'm dealing with the yen, having exchanged my US dollars to Japanese yen, I was doing business with those guys and they just gave me a set number. But even still, if I was just dealing with a regular person out in the street and we were exchanging money, we would have, say, like, technically you just kind of paid whatever you want. And like a lot of like friends, you would just say, oh, $1 for 100 yen. And it was just an even exchange rate. And so when you do an exchange, you kind of have, in my eyes, you have some say so on what goes on. Like it's a two-way streak. When you're learning the foreign exchange, all you ever hear and all you'll ever keep telling yourself is it's a foreign exchange market. And then if you already have ingrained in your brain that the exchange, that the definition in the word exchange in your head already is a dealing between two people, it's a two-way streak and both people have input and say so. If that's your definition of an exchange, and then you start learning the foreign exchange market, because of the word exchange already being ingrained in your head, now you keep telling yourself foreign exchange, then the whole foreign exchange market is going to kind of work that way. You think that, you can trade these currencies pairs back and forth between somebody, like maybe these interbanks are trading back and forth. That's how I thought for 4 years, because it's the foreign exchange market. You're dealing with currency pairs. You're dealing with people. Of course you have to say so, because it's an exchange. But I just realized that that's not how it works. In the Forex market, you have your price of where the market is at, and then you have your asking price, pretty much your asking price, and then the bidding price. And so your asking price is always higher than the bidding price. You want to talk about inflation, how things are always supposed to increase. That's the law almost. And that's pretty much life law, is inflation is never going to go away. Obviously there's points in our lives, in our government's lifetime, where they've dropped significantly, but it always goes back up. Inflation happens, and so the asking price for something is always going to be higher than what the price actually is. And so when you start trading Forex market and you're trading with a small account, or you're making a small movement, or if you're trying to scalp the market, which a lot of people try to do, is you want to get in at this price. But you get in it and you realize, well, hey, I'm not, like, the market's going up, and I told myself, and I made the contract that the price was going to go up. The market's going up, but why am I still negative? Is because you still have what is known as a spread in between your bidding price and the asking price. It's what's known as a spread. And so the market can go up and your analysis could be going up. But if you have too big of a spread within your exchange, then it's going to be a little bit before you actually make any profit for it. So you want to make sure that you're using the right exchange. But even still, the asking price is always higher than the bidding price, because if I give you yen at 109 for every dollar, and then you just go willy-nilly, and then you and I would say, hey, can I buy that yen back? I really, really need it. And then you're just like, man, fuck you. I want 115 for it. And then now I got to pay more just to get it back, even though I paid 109. It's called supply and demand. How bad do you want it? And keep in mind, when I'm talking about an exchange going between two people, that's not how the forex market works. That's not how these currency pairs are being traded, because it's not these two people regularly going back and forth with each other. It's, hey, this person visited this country, so they want this money, and this is what they're going to pay for it based on what's going on in our world around us. Now these people leave. Well, now more people are coming, and business is booming. So guess what? I'm going to raise my prices even higher. And as these people keep coming and wanting to come to my country, I'm raising the price because I can. This is the asking price and this is a bidding price. And as long as they keep hitting it, I'm going to keep rising it. And then you're going to get to a point where demand is not high anymore, or it's overbought. If it's overbought and now people don't want it anymore, then the price will go back down. And that's how it works, because people don't want it anymore, or they're interested in something else that's going on in the world. They'll go to a different currency pair, and now the asking price is lowering because people don't want it anymore. Of course, people still want it. That's why the price isn't going to plummet completely, but less people want it. So therefore, because other people are going elsewhere, you're never going to get the same customer all the time. Like, I would never say you're not going to get them twice, but they might eventually come back. You never know. But I can safely say you're not dealing with the same people twice. These currency pairs that are being traded amongst whoever, these big banks, it's happening once in a while. Those transactions between those two customers, it's not an exchange. It's a one-time deal. It's a one-time streak. And these guys are like, fuck you, pay me this price. Oh, you don't want to pay me this price? Too bad, so sad. You know what? I'll raise it. You want to talk about bartering? That's what these guys do. They barter. They just keep raising the price because they fucking can. Why not? And then supply goes down. Well, now they got to lower their price. It's all about supply and demand. And when you look at the forex market, you can see you can see the support and resistance, your supply and demand, because people are trading the forex market, and whether people believe it or not, there's a psychological aspect, and there's a psychological movement that moves within the foreign exchange market. I figured it out, and I'm willing to teach people. It's up to you whether you want to learn it or not. But I hope I've explained it, hopefully in a way that you can visually depict. If not, just ask questions. I'll be glad to explain it some more. I meant to write down notes to better help me explain this better, but I figure I might as well just go off the top of my head and just tell you what I know. I can always explain it again, explain it better, explain it different. It's up to you. Well, it's up to us to figure out the best way to go about explaining this, but because I'm trying to make people rich as shit, because I'm going to be, because I know what I'm doing. And if I can better explain to everybody else how to do what I'm doing, why not? And that's what I'm trying to do. See you later.